Welcome to the Confessions of a Recovering Landlord podcast, where we let you in on the secrets commercial landlords would prefer you not know. Brought to you by our friends at Riata Commercial Realty, Inc. We exclusively represent users of office and warehouse properties. Landlords have representation. Do you? 8 reasons. Count them. I hear people like numbers in posts, so we'll start with 8 reasons to buy a building instead of leasing a building.
Oh,
But my first question is, don't you lease buildings for your clients?
I do, but I also help clients buy buildings. And I also help them sell them or sublease them if they don't need them anymore.
You satisfy the occupier's need for space, whatever form that may take. That's our new tagline. Hang on, I got to revise our website.
That's a long tagline.
Okay, let's start with numeral uno. Long-term costs may be less. True or false?
I'm going to say false because it says maybe, and it should say always.
Okay. Oh,
Oh,
he should always record in the morning, not in the afternoon. He's too full of piss and vinegar by this time of the day.
Or maybe we should do it during happy hour.
Again, that's a paywall issue.
All right. So I'm kind of half joking, and there are going to be times when it's not cheaper to buy than to lease, but almost every time that I've run the numbers, it has been. And the reason is because the rental rate that the landlord has to charge has to take into account things like the improvements to the building that a tenant's going to make, not just now, but what about the next tenant? Or what about the current tenant when they renew? And what about the downtime between tenants while the building's sitting vacant? And so there's a lot of costs that a landlord will build into their model, and they've got to be compensated for that. And so the rental rate takes those things into account. So when you run the numbers and you just say, hey, how much money is going out the door if I lease the building? How much money is going out the door if I buy the building? Almost always it's cheaper to buy the building in the long run than it is to lease it.
Well, and I hate blowing smoke up your skirt because goodness knows I have to live with you, but you have a handy dandy spreadsheet that whenever anyone comes to you and says, I really like this, but I want to do that, but what about this? You put it into this spreadsheet that will go down to the per square foot price of buying versus leasing, and it shows them everything. And I think it's just such a crystal clear way to take the emotion out of it. I mean, there's always emotion involved, but that can really help to clear the smoke out of the air if they have any type of question or considering, maybe there's value that isn't on the paper, and that's fine. But we're going to put all the numbers on the paper so you can see where your dollar bill's going. And that's what I like about that spreadsheet.
Well, and I would also say regarding that spreadsheet, you mentioned that it brings it down to the dollar per square foot, and it does do that. However, the dollars per square foot only makes sense to consider is if you're comparing two options that have the same square footage. And so usually if you're looking at the same building and you're saying, am I going to lease this building? Or am I going to buy this building? Obviously it's the same square footage, and therefore the price per square foot matters. If on the other hand, you're looking at two different buildings, well, they're probably not going to have the same square footage exactly. Or if they do, they're both 10,000 square foot buildings. Well, do they really have the same utility? Because there might be rooms where the way it's built out is set up so that you only have, 20 offices in one and 19 in the other. So, maybe the cost per employee is more important. So we look at it really more on the total dollars spent. And we do show the per square foot, but that's not as relevant in many cases. And so anyway, yeah, you're right. It's a great spreadsheet. And that spreadsheet, by the way, we have a place for it to consider possible appreciation in the value of the building, but we don't think that that's a relevant factor. It's not something we should consider because I can make any investment look good if I assume enough appreciation. I had this exact conversation with somebody at lunch today, and I was like, and they want to buy and on their next deal. And I just said, we're not going to consider any appreciation. You can play with that if you want to, but I don't recommend it because it gives you a false answer.
So number 2 is customized for the long term.
Well, that's simply, if you have a very specific use for your company, you may need to have it very customized for your purposes. So, for example, we had a client several years ago that was in the movie, film, TV production space. And so they wanted to buy a building where they could build it out exactly the way they wanted to and have it for the long term. And so they went to crazy extents. I mean, they added a lot of power, they added a lot of air conditioning, they added a grid with a really high tech ceiling. I'm sorry, not a ceiling, but a light system. You could push a button on an iPad and totally change the way that studio was lit. And they had like 20 presets and an infinite number of other ways to modify that. They had each studio had really, really thick walls and spray-in insulation on every wall. The doors were just as thick to eliminate sound. They moved the air conditioning systems on the roof off the section where the studio was so that it wouldn't vibrate the ceiling and create sound. I mean, on and on and on. They put solar panels on the roof, and they set the panels on top of where the main studio was, so that if it was raining, it would hit those panels and not the roof and transfer sound. I mean, it was crazy.
Highly specialized.
So that's the kind of thing where, if you're going to do something like that, or you're going to have a specialized manufacturing situation, buying it makes sense because you don't want to spend all that money and do a 5 or even a 10-year lease and then potentially have to walk away from that infrastructure. Right. That's why, for example, for a dentist, the cost to move a dentist is astronomical, and landlords know that. So when it comes time for them to renew their lease, they're like, I got you. You can't really go anywhere else without having to factor that cost in. Yeah. And I can charge you almost anything I want, and it's still cheaper for you to stay where you are.
Oh, don't be a dentist. Oh, that's not where we're going. Okay.
I don't think that was the moral of the story.
Number 3 is equity buildup. Now, I know you said you're not considering that in a lot of face-to-face comparisons, but it is a factor to be considered or discussed.
Well, now there's 2 different things there. I said we don't consider the appreciation of the building,
right. Okay.
But that's different than equity buildup.
That's true.
Because every time you make a payment on your mortgage, a piece of that is interest and a piece of that is principal. Sadly, on the early years, a lot more of it's interest than principal, but there's still some principal. And so if you look at it after 10 years, if you have a $2 million loan, let's say, then after 10 years, maybe your loan payoff is, I don't know, $1.4 million. I don't even know what the number is off the top of my head. So that $600,000 that you have put into the piggy bank known as your building, that I do consider, because I do think that, I'm assuming that the building value is not going to fall. And you know what? It could, but usually it doesn't. So I do consider that equity buildup based on your mortgage payments in the analysis, but I don't consider any further appreciation above the price paid for the building.
Okay. Number 4, appreciation. We're just going to get them all out of the way right now.
Forget everything else I just said. No, I'm kidding. I think in the analysis, you should ignore appreciation. However, the reality is that in the big picture, on the whole, buildings do tend to appreciate over time. So that is a benefit that you get to capture, that you only get to capture if you own the building. You don't get to capture any of that if you're leasing the building. So it is an opportunity, but it's not a guarantee. So I think it's a great thing if it happens, but you don't want to count on it. Therefore, you don't put it into your analysis.
Right. It's a talking point, but it doesn't go in the spreadsheet.
A very short talking point.
Okay, this info is a little dated, but low interest rates.
Yeah, you can tell.
Interest rates are going to factor in no matter what, because you're going to have tenant improvements. And unless you're paying for those in cash, you are going to have to finance those.
Yeah. And I mean, most people don't finance tenant improvements on a building they own unless they are also financing the building. Because you can wrap all that together. So if you're going to buy a building for $10 million and you need to spend another $1 million or $2 million on improvements, well, you're really doing a $11 or $12 million deal. and you're talking to your bank about the overall deal.
Mm-hmm.
We have a client that's buying an office condo right now, and that's the same thing. There's, I think they're spending $355 a square foot on the building shell, and then another $94 a square foot on the improvements. So we're really looking at that total cost and their evaluation of it. So on interest rates, you're right. I mean, this is actually a blog that I wrote a long time ago, and interest rates were very low at that time. But you know what? They're not as high as you think they are today
Yeah,
still.
they're still really, really good.
I mean, this client that's buying this office condo is getting a 6.9% interest rate. And it's kind of funny because another friend of mine who's a banker who also competed on that same deal couldn't get within a half a point of that and was really frustrated he didn't get the deal. And, I was surprised he didn't get the deal, honestly. But historically, 6.9% is still not bad, especially if you compare it to a lot of other times in history.
Mm-hmm.
The thing that's interesting to me, though, is that, I've run this analysis for a very long time. And when interest rates were, say, 4%, and let's just say we're comparing a buy versus lease of the same building, and the client could buy the building for 70% of the cost to lease it over a 10-year period. Now, with interest rates being call it 7%, well, instead of it being 70% of the cost to lease it, maybe it's 78% of the cost to lease it,
Right.
80%. It's still better than
winning.
leasing it.
Right.
So that's the moral of the story. Interest rates are low enough to where it still makes sense to buy it instead of lease it.
Number 6 is flexibility. And you're going to have to explain this because it feels like you're more flexible when you lease, but I know where you're going with this one. So
then go ahead and tell us.
Well, I buy a building. I use it for my own purposes. Oh, I overextended and I shrink. I don't need all my space. I call you up and you sublease it for me. And now I'm not only an owner occupied, but I'm a landlord and I'm making money on the rent. There's a lot. It's not the stuck feeling it used to be.
Yeah, it's interesting that I've had a lot of people in the past say, I don't want to buy a building because I don't want to be stuck with a building.
Right.
And it's
You're
actually
stuck with an income producing asset, my friend.
well, and it is interesting. What you said is absolutely true, that if you own a building.
I'm sorry, just one more time, slowly and with feeling.
I knew that was coming. So if they own the building and they don't need to use it anymore, now they can sell it, they can lease it.
They sublease a part of it if they have shrunk up or they've opened a second location. They're only using half this now. There's so much more flexibility than you think there is.
Well, and if you own the building and you own the business, now you want those to be owned by separate entities in almost every case, subject to what your attorney and your CPA tell you, of course. But you always want them to be separate because we have had clients that have sold the business and kept the building and leased the building to the new owner of the business, and the business stays right where it is. We've had them sell the business moves out, and then they sell the building, or they keep the building and lease it. They're two separate assets. One is called an operating business, one's called a building. And so the flexibility is that you can do all those different things with it. But let's go back to the thing about the idea of being stuck. I actually argue that you're more stuck with a lease than with a purchase, because
just try to get out of one. You'll understand just how stuck you really are.
well, if you sell a building that you paid $5 million for 5 or 8 years ago, chances are it's going to be worth more than what you paid for it. And at worst case, it's probably worth the same thing you paid for it. Now, if you take a look at what you paid for it and the improvements you made, like in the case of the very complicated studio I mentioned, all right, maybe that one's not going to pencil out and you're actually going to lose a little money, but you've amortized a lot of those improvements because of your specific use, and it allowed you to make money in your business. So are those business assets or are those real estate assets?
Right.
That kind of gets a little blurry. So my argument is that you can sell usually for the same or more money than you paid for it. Whereas if you go to sublease, If you're paying $35 a square foot on on your primary lease, and you go to try and sublease that space, especially if it's office space, you're probably not going to get anywhere close to what you're paying. And usually we see the recovery. Let's say, you go and sublease your space, the percentage that you recover of the amount you owe the landlord for the remainder term is usually going to be only somewhere in the 50 to 70% range. Industrial space, it's probably a bit better than that. Possibly the same for medical, although that I don't see as much subleasing happening in medical. But in office buildings, you're going to take a big hit. So if you can sell that building instead of sublease it, you're probably better off. Therefore, I think flexibility is actually better when you buy a building than when you lease it.
Yeah. Number 7, multiple assets.
Well, I kind of gave that away in the last discussion about you own the building, you own the business, and you own the building separately. So I kind of already addressed that. So that's really what that was about.
So number 8 is accounting treatment.
So the accounting treatment, I'm not an accountant, don't want to be, never have been, but the issue is, number one, consult your accountant and not your commercial real estate broker for tax advice. But if you lease a building, 100% of your lease payments are deductible. If you own the building, you don't get to write off your entire payment because part of that is paying principal. You do get to pay or deduct the interest, and you also get to depreciate the building, and you get to depreciate the improvements in the building. So there's a concept called cost segregation. And cost segregation basically says for a commercial real estate property, the real estate improvements, you can't depreciate land, but the building itself, you can depreciate over 39 years. Well, what about the carpet, the curtains, other improvements on the inside that don't have a 39-year life? Well, the IRS lets you do faster depreciation on those items than on the foundation, roof, and walls. So that cost segregation basically says if you buy a building for $5 million, what percentage of that was allocated to the land? So let's just say $1 million allocated to the land. That leaves $4 million for improvements. How much of that is the building itself, and how much is it all these other things like your curtains, et cetera? And so you want to depreciate those accordingly to maximize your tax advantages. In addition to that, the Financial Accounting Standards Board, which is the body that sort of comes up with the rules for GAAP accounting, generally accepted accounting principles, they, a few years ago, changed the way companies that are subject to GAAP accounting requirements account for their leases. So it used to be that if you owned the building, it was on your balance sheet. If you leased a building, it was not. Well, now if you subscribe to the GAAP accounting standards, then you do capitalize your lease. What does that mean? It means that, if you have a lease that's worth $5 million, where your lease payments over your lease life is $5 million, well, you have to show that on your balance sheet as an asset, which is a right to use asset. And you have it on your liabilities, which is, hey, I got these lease payments in the future coming up. So you have to show both of those things on your balance sheet. Well, they net out to zero. It doesn't have any impact at all to the net earning or to the net worth or stockholders' equity in the business. So why is it on there? It's on there because it skews things if you don't. If let's say I'm an investor and I'm looking at one business that owns the building and it's on the balance sheet, and I'm looking at another business that has no real estate impact on the balance sheet whatsoever, even though I know they lease their properties instead of own them, which is the better the better business. As an investor, as somebody who's going to invest in stocks,
right,
which is the better one? I don't know. So by forcing them to put the lease on the balance sheet, it now kind of levels that out a bit and makes it more apples to apples, I guess is the way to say it. Still not perfect, but it's still better than not having it there at all.
We would like to thank you for joining another episode of Confessions Of a recovering landlord.
I was like, is that my cue? Your little pause. All right. Thanks.
What's with the glasses? So we can turn it off?
I got to be able to see the screen to stop the recording.
Until next time.
Bye.
Thank you for listening. And just a reminder to send in questions to see if we can stump Bob.
Not going to happen.
We really appreciate your taking the time to tune into this episode. We would love it if you would give us a 5-star rating on whatever platform you're listening to this on. And if you are on our YouTube channel, we would love to read your feedback in the comment section. Also, be sure to subscribe so you get notified when we publish new episodes. Thanks, and see you next time.
Bye.